Last week we showed the math of market timing is, well, surprisingly generous.
Generous is almost an understatement, honestly.
Right. I mean, on 99 years of CRSP daily data, a break-even classifier can afford 33 false alarms per clear, correctly avoided -2% day.
Which is huge.
It is. It can be OUT of the market for 150 days a year and still just match buy and hold.
Yeah, the math says timing is easy.
Exactly. And we left you with one loose thread. All of that math rests on the assumption that false alarms are evenly spread across calm days and time. So today, we put that assumption on trial.
And spoiler alert here, the tape fights back.
Oh, it really does.
Yeah, because financial markets just, they don't operate in a vacuum of perfectly distributed independent events. The way risk actually unfolds completely shatters that theoretical uniform distribution we talked about.
So looking at the massive stack of research papers and the historical data you've sent in for us today, our mission for this deep dive is to see exactly how that happened.
Right, we're getting into the weeds.
Yeah, we are taking 99 years of U.S. stock market history. Specifically, the CRSP Daily Value Weighted Total Return Index.
Spanning from 1926 clear through 2024.
Yep. And for those tracking the math at home, that is 26,050 trading days with a full sample compound annual growth rate, or CGR, of 9.52%.
Which is a solid run.
Definitely. And we are looking strictly at the historical tape here. No theoretical models operating in a vacuum, no hypotheticals.
Just cold, hard historical fact.
Exactly. To uncover the economic mechanisms that just destroy that generous math we established last week. And I have to say, I am so incredibly excited to dismantle this widely believed financial assumption with you.
Me too.
Because the truth we found in your sources is so much wilder than the theory.
It really is wild.
Yeah.
And to understand why the theory falls apart, we need to run a head-to-head test using the data you provided.
Right.
We're going to look at two synthetic models, these are classifiers, that are trying to do one very specific job. Target and avoid the worst 2% of market days.
Okay, and out of those 26,050 days in our 99-year sample, the worst 2% equates to exactly 522 days.
Correct. So we're hunting those 522 really bad days.
Okay, let's unpack this. On paper, the sources set these two classifiers up as identical twins.
Yeah, they get the exact same skill level.
Right. They both have a true positive rate of 55%. That means they both successfully catch and avoid 55% of those 522 terrible days.
Yep.
And they both have a false positive rate of 10%, meaning they get spooked, and incorrectly tell you to pull your money out of the market on 10% of the perfectly fine, non-bad days.
They essentially cry wolf 10% of the time.
Exactly. Now, I saw a term in the research papers referring to this setup. They said the models have the exact same confusion matrix.
Oh, yeah.
Before we go further, what does that actually mean in plain English?
Good catch on that. So a confusion matrix is just a grid used by data scientists to measure how confused a model gets. It just maps out four things. The times the model was right about a bad day, the times it missed a bad day, the times it was right about a calm day, and the times it cried wolf, those false alarms.
Right, the false positives.
Exactly. Because our two models have the same true positive rate and the same false positive rate, their confusion matrices are literally identical.
So by every standard statistical metric, you would look at these two models and grade them exactly the same.
You'd think they were the exact same model.
Yeah. But the sources changed the rules for the simulation. The only difference between these two identical twins is where those false alarms happen in time.
Right. Placement matters.
Right. So our first model is the random classifier. It scatters its 10% false alarms completely evenly across the 99 years, perfectly matching that assumption we talked about last week.
Yeah, and the second model is the cluster-aware classifier. Instead of spreading the false alarms out like peanut butter over 99 years, its false alarms clump together.
Like they bunch up.
Exactly. They group up heavily during periods of high market stress and surround the actual bad days. And this raises an important question. What happens to your money when we run them both through the 99 years of history?
The results in the data are staggering. I mean, the random classifier, the one that spreads its errors evenly, yields an excess CAGR of plus 8.3% per year over a simple buy and hold strategy.
Which is massive.
It essentially turns you into a Wall Street legend.
Truly.
But the cluster-aware classifier, it yields approximately 0% excess KGR. Sometimes it even dips slightly negative.
Yeah, it completely wipes out the advantage.
Same accuracy, same confusion matrix, but one makes you incredibly wealthy and the other essentially goes nowhere. How can two models with identical test scores create such wildly different fortunes?
That's all about when you make the mistake.
Exactly. Think of it like a leaky roof. If you have a leaky roof and it drops one drop of water every single day for a year, a random leak spread out evenly in time, it's a nuisance.
Right, you put a bucket under it.
Yeah, you mop it up occasionally. That is our random classifier. It's annoying, but the house survives perfectly fine. But what if that exact same total volume of water doesn't drop evenly? What if the leak only opens up entirely, dropping hundreds of gallons of water in a single hour right in the middle of a Category 5 hurricane?
Well, it completely destroys the house. The
Yeah.
ceiling caves in.
Exactly. The cluster-aware classifier is dropping all its false alarms right when the market is at its absolute most violent. And the penalty for being wrong in the middle of a hurricane is fatal to your portfolio.
It's a total disaster.
But wait, I'm looking at another test in the data stack where they run a model that's just, well, bad. What happens then?
Oh, that's where the math gets genuinely punishing. If we test an uninformative cluster-aware classifier,
Meaning it's just not good at its job.
right, one that catches only 10% of the bad days, but still has that 10% false alarm rate clustered around stress events, it literally destroys 8 percentage points of your CGR.
Wow.
Yeah.
Yeah.
It drops your portfolio off a cliff. Now, a listener might ask why we even care about the cluster-aware model. It sounds like a worst-case scenario engineered to fail, right?
Right, like a straw man.
Exactly. But it's not a straw man. It represents exactly how real, well-specified financial models behave when they are actually released into the wild.
Wait, I'm stuck here. If a financial model is designed by brilliant quants to be so smart, shouldn't it recognize that a massive market drop creates bargain hunting opportunities?
You'd hope so.
Right. Why does it just blindly panic and cluster its alarms like that? What is the underlying heartbeat of the market that forces the model to act this way?
Well, it all comes down to the gravity of volatility.
Okay, the gravity of volatility.
Yeah. If you look at the day-to-day returns of the stock market, just the direction, up or down there is almost zero autocorrelation.
And meaning they aren't connected.
Right. Knowing today was down tells you virtually nothing about whether tomorrow will be up or down. You
Yeah.
just can't predict the direction. But if you look at the magnitude of the returns, the absolute size of the move, regardless of direction, it is highly persistent out to about 20 trading days.
Oh, wow.
Yeah. Big moves cluster with big moves. Small moves cluster with small moves.
So if the market swings wildly today, it's highly likely to swing wildly tomorrow, even if we have zero clue which direction it's going to go.
Precisely. And real downside risk models, they feed on this volatility. When a bad day hits, the model detects a regime change. It sees the math breaking down and fires an alarm.
Because it's trained to avoid risk?
Exactly. But because the volatility persists for weeks, the model keeps firing. It stays spooked because the mathematical stress in the system hasn't dissipated yet.
Let's make this concrete.
Well-
When the model detects that stress, what does that actually look like on the trading floor? The research mentions things like liquidity providers stepping back and margin calls. Can we explain the actual mechanics of that?
Absolutely. Think about market makers, the institutions that are always willing to buy or sell a stock just to keep trading moving smoothly. Normally, they might offer to buy a stock for $100 and sell it for $100.05. That tight spread is their profit.
Makes sense.
But when a sudden panic hits, like the onset of the 2008 financial crisis or, the extreme uncertainty of March 2020, those market makers get terrified of holding the bag.
They don't want to get stuck with losing assets.
Exactly. So they widen their spreads dramatically. They might offer to buy at 90 and sell at 110. That sudden evaporation of liquidity artificially exacerbates the price drop. Every trade basically hits an air pocket.
And then you add margin calls to the fire. You have investors who borrowed money from their brokers to buy stocks. The broker sees the portfolio value dropping and issues a margin call saying, deposit more cash right now, or we are selling your stocks to pay off your debt.
Yeah, and the investor might not have a choice.
Right. It's mechanical, forced selling into a market with absolutely no liquidity.
That's the hurricane. The model sees this violent, forced selling, assumes the world is ending, and yells at you to sit in cash.
Okay, so the model is spooked, the alarms are blaring, and you are sitting in cash. What is actually happening in the market during those exact same days? Let's look at the 1 to 5 trading days immediately following a bad day, like a -2% drop.
The tape tells a crazy story here.
It does. The historical event time paths show something incredible. The market rebounds, and it rebounds hard. The average daily returns on those immediately following days are meaningfully positive.
Yeah, and what's fascinating here is that a bad day isn't an isolated event. It kicks off a high volatility window. You have that liquidity retrenchment and forced selling driving the price down.
Right.
But then, almost immediately, the rubber band snaps back, bargain hunters step in, the forced sellers are totally exhausted, and you get a massive surge of positive expected returns.
So for you, the listener, here's the brutal translation. If your model gets spooked by the initial crash, that persistent lingering volatility means your model keeps you sitting on the sidelines in cash right at the exact moment the market starts violently surging back upwards. You are missing the rebound.
And the data proves just how tight that relationship really is. We know volatility clusters and we know rebounds happen. But exactly how close together in time are the absolute extremes?
I was looking at the data sheets in our source stack for today, and this statistic completely blew my mind.
It's a wild one.
If you look at the 10 worst days in the entire 99 years of CRSP history,
Yeah.
how many of them had one of the 10 best days happen within just 10 trading days?
Just 10 days out of 26,000.
Right. We are talking about 10 days out of 26,050. That is a tiny fraction of time. It's like blinking during a 3-hour movie.
9 out of 10.
9 out of 10.
Yeah.
And the sources go further. If you tighten the window, 60% of the top 10 worst days have a top 10 best day within just 3 trading days.
Best days and worst days share an address.
Here's where it gets really interesting. By trying to build a radar that specifically detects the worst days, you are accidentally building a radar that perfectly targets the absolute best days.
You can't separate them.
No, they live in the exact same neighborhood.
And this completely breaks the math behind those scary charts financial advisors love to show you. Because best and worst days share an address, that marketing pitch isn't just slightly misleading, it is a mathematical trap.
Oh, we all know the one. Every financial timing pitch has some version of this scare statistic. If you just miss the 100 best days out of the last 26,000 trading days, your 9.52% AGR plummets to a dismal 3.5%.
Well, it's terrifying.
It is. It makes you think you must stay invested at all times, no matter what. But the sources point out an inverse to that stat that is absolutely true, and Wall Street never talks about it.
Nope, they never mention it.
If you manage to miss the 100 worst days, your AGR skyrockets to an unbelievable 16.37%.
See, the pitch relies entirely on ignoring that symmetry. But let's look at the collision. What happens if you miss both? What happens if you remove the 100 best days and the 100 worst days from the 99-year record?
Your AGR drops to 9.98%.
Exactly. Yeah. Well, to put it in perspective, it's barely half a percentage point above a completely passive, simple buy and hold strategy.
Think about that. All that stress, all that frantic trading, all that sophisticated timing, just to move from 9.52% to 9.98%.
A lot of effort for very little reward.
Right. But surely a clever investor is listening right now saying, can I just be smart? I'll step out for the bad days, dodge the crash, and then confidently step right back in to catch the good days.
Mathematically, the sources show it is almost impossible, and we can measure the collateral damage of that strategy. Let's give you a crystal ball. Perfect foresight.
Okay, a magic wand.
Right. You successfully exit the market on every single one of the 100 worst days in history. Incredible. But you are human, so you say, I'll just stay out for 3 days to let the dust settle, then get back in.
Seems reasonable.
Yeah, but by staying out for just those 3 days, you mathematically miss 37 of the 100 best days.
Wow. And if you decide to play it a little safer, because the news is terrifying, and stay out for 5 days,
You miss 42 of the best days.
if we connect this to the bigger picture...
Yeah.
Oh, wait, I mean, if we just look at how these days interact, the famous missing days scare stat and its inverse completely cancel each other out. Because they are clumped so tightly together in time, you simply cannot act on one without accidentally acting on the other.
And this brings us to human psychology, which acts as an accelerant to this mathematical trap. If getting back in immediately is practically impossible because of collateral damage, what happens when human fear takes over and makes us wait on the sidelines?
We've all been there. You watch the market drop violently, your portfolio bleeds, you finally capitulate and sell, and you tell yourself, I'm just going to wait for things to calm down before I buy back in.
A very human reaction.
Totally. Let's look at the actual cost of multi-day exits documented in the data. Let's give you that crystal ball again. You exit on the worst 2% of days with perfect foresight. If you conquer your fear and come back the very next day, your excess CAGR is an incredible plus 19.3%.
Which is phenomenal.
But what if you wait just 10 days for things to calm down before re-entering? Your excess CAGR drops to plus 6.6%.
That's a massive drop.
So what does this all mean? Going from a one-day exit to a 10-day exit costs you over 12 percentage points of compound growth. And that is with a crystal ball telling you exactly when to sell.
And here is the truly painful part of that statistic. Over 95% of the return you missed during those 10 days on the sidelines comes from positive days.
95%.
Yeah. You aren't sitting out a prolonged grinding crash. You are sitting out the rebound. By the time the volatility has calmed down enough for human psychology to feel safe again, by the time the news stops yelling at you, the massive recovery has already happened without you.
Now, I can hear a common listener objection right now. Someone is analyzing this deep dive and saying, wait, what about trading costs? Doesn't the friction of buying and selling, of the broker fees, the bid-ask spreads, doesn't that eat up all the profits of timing anyway?
It's a valid objection. Transaction costs absolutely matter. If we apply a 10 basis point transaction cost to these models, meaning a fee of 0.1% on every trade, it shifts the break-even math slightly.
Okay.
You need your model to be a little more accurate to overcome the fees, but, and this is a crucial distinction made in the research, the clustering effect we've been talking about, that drops your performance by a whole skill tier. Trading costs matter. They're just not the main course.
Frictions are a side dish. The clustering is what actually starves the portfolio.
Precisely. You can have a magical broker with zero transaction costs, but if your model forces you to miss the rebound, you lose.
Which brings us to the absolute core truth of this entire deep dive. Looking through all 99 years of this historical data, if there is one thing you take away from this conversation, it has to be this. Avoiding crashes and missing rebounds are not separate problems. They are the same problem.
They're the same problem. Because the cure timing the market to avoid the pain of a crash mathematically forces you to swallow the disease, which is missing the massive rebounds that immediately follow.
Wow.
I think this gives you a whole new lens for your own behavior as an investor. Perhaps the anxiety you feel during a massive market drop isn't a signal to run away and hide in cash.
What else would it be?
Well, perhaps that anxiety is simply the mandatory admission ticket you have to punch to earn the subsequent surge. The volatility isn't a malfunction of the market. The volatility is the vehicle.
The volatility is the vehicle. I love that. So the synthetic theoretical classifier failed spectacularly once we introduced real-world clustering. But we have to be fair to the quants. That was a stylized setup.
Right, it was engineered.
Yeah, we engineered those synthetic models specifically to prove a point about the underlying mechanics. What about a real model? What if we built something highly sophisticated?
That's the real test.
The sources tease a model using 30 lagged features. Strict, expanding window training, 90 years of out-of-sample data, a real-world area under the curve, or AUC, of about 0.75, which, for context, means its predictive power is significantly better than a coin flip, but it's far from a perfect crystal ball.
A model that actually tries to thread the needle through the hurricane.
Exactly. Oops, I mean, that is the perfect way to put it. Next week, we grade that real-world model. Thank you so much for joining us for this deep dive. We craft these specifically to cut through the noise and give you the real data. Until next time, stay curious.